Imagine waking up every month to a paycheck, not from a job, but from your investments. For many, this dream is tied to one ETF SCHD. But what if I told you there's a way to live off dividends without SCHD? Whether you're preparing for early retirement, building a passive income stream, or just want to diversify beyond the crowd's favorite dividend ETF, this video is your ultimate guide. We're about to dive deep into 4 powerful dividend ETFs that can give you consistent income, strong risk-adjusted performance, and financial independence, without relying on SCHD. Each one offers a unique edge, and by the end of this video, you'll not only discover them, but also learn how to combine them into a complete portfolio that could pay you for life. Let's get started. Let's kick things off with a dividend ETF that's like the quiet, responsible sibling in the investing family, Vanguard High Dividend Yield ETF, or VYM. VYM is designed to track the FTSE High Dividend Yield Index, which means it focuses on large, established U.S. companies with a track record of paying solid dividends. It doesn't chase high yields recklessly, it selects financially sound businesses that consistently reward shareholders. Holdings: over 400 companies, yield around 3% as of 2024, expense ratio 0.06%, top sectors: financials, healthcare, consumer staples. Diversification: over 400 holdings across many sectors. This minimizes the risk of relying too heavily on any one company or sector. Low fees: at just 0.06%, it's practically free to own. Vanguard's cost efficiency gives more money back to you. Sustainability: it avoids yield traps and focuses on long-term dividend consistency. Investors seeking broad U.S. dividend exposure, retirees who want reliable income without volatility, those looking to replace SCHD with something less correlated. You can think of VYM as your foundation ETF, a core holding that provides dependable income while preserving capital. Next up is a true dividend veteran, iShares Select Dividend ETF (DVY). This ETF doesn't just chase any company with a high yield, it filters for quality dividends and fundamental strength. DVY focuses on U.S. companies that not only have high dividends but also consistent earnings and solid payout ratios. Unlike VYM, it's more sector concentrated, leaning heavily into utilities and industrials. Holdings: around 100 companies, yield roughly 3.5 to 4%, expense ratio 0.38%, top sectors: utilities, industrials, energy. High dividend focus: if you're looking for income now, DVY delivers. Dividend track record screens out companies with weak payout histories. Defensive leans strong in recession-resistant sectors like utilities. Higher fees than peers like VYM. Less diversification, more sector concentration. Oh, so who exactly is DVY ideal for? Well, it's perfect for investors who are near or already in retirement. Also, anyone seeking monthly cash flow will find it beneficial. And if your portfolio already includes growth ETFs like QQQ or SCHG, DVY could be a great addition. DVY is like the cash generator in your portfolio. Perfect for those who want real income and are less worried about growth. Now let's get defensive. iShares Core High Dividend ETF, or HDV, brings a completely different flavor to the dividend game. It combines dividend yield with financial strength. HDV screens stocks using Morningstar's economic moat ratings and financial health metrics. That means it's not just about yield. It's about high-quality, resilient companies that can weather market storms. Holdings: around 75 to 80 stocks, yield approximately 4%. Expense ratio 0.08%. Top sectors: healthcare, energy, consumer staples. Defensive exposure, especially strong in healthcare and consumer staples. Low turnover, minimizes trading costs and boosts stability. Financial quality filter, focuses on firms with strong balance sheets and cash flows. HDV is more concentrated than VYM. Its performance can lag in bull markets due to its defensive tilt. HDV is ideal for conservative investors who value capital preservation. It's also a good fit for those worried about recession or volatility. And of course, investors who want to add quality-based screening to their dividend portfolio will find HDV appealing. HDV is your moat builder ETF. It's great when you want income without exposing yourself to fragile businesses. Last but definitely not least, JP Morgan Equity Premium Income ETF or JEPI. This ETF is built to do one thing extremely well: generate monthly income. JEPI doesn't rely solely on dividends. It combines blue-chip stocks with covered call options to enhance income. The result? Yields of 7 to 10% paid monthly. Holdings: approximately 100 U.S. large-cap stocks. Yield 7 to 10% paid monthly. Expense ratio 0.35%. Option strategy covered call overlay. JEPI stands out with some impressive strengths. First up, high income. It's possibly the best income generator among all ETFs here. Next, monthly payouts, which are ideal for budgeting and retirement. And lastly, lower volatility. The covered call strategy helps smooth out those pesky price swings. But as with anything, there are some cautions to keep in mind. JEPI has a lower capital appreciation potential. It's also more complex due to the options overlay. Plus, the income can fluctuate with market conditions. So who is JEPI ideal for? Well, retirees or FIRE investors needing monthly income will find it appealing. Conservative investors wanting lower volatility might also be interested. And it's a good option for those looking to replace bonds or REITs in their portfolio. Think of JEPI as your dividend accelerator. It pays you more often and smooths the ride. Now, instead of picking just one of these ETFs, imagine building a dividend powerhouse portfolio using a strategic blend. 40% VM your foundation. 30% HDV adds quality and defensive exposure, 20% JEPI delivers monthly high income, 10% DVY gives you that utility-heavy yield kicker. Diversified income sources, exposure to multiple sectors, balances yield and safety. This kind of allocation could provide 5 to 6% annual yield, reduce risk, and generate a reliable cash flow stream for retirement or early financial freedom. You don't need SCHD to build a rock-solid dividend portfolio. These 4 ETFs, VWM, DVY, HDV, and JEPI, each bring a different strength to the table. VM, broad, low-cost reliability. DVY, high yield with a proven track record. HDV, defensive quality for uncertain times. JEPI, monthly income on steroids. Whether you're 30 and building wealth or 60 and ready to live off dividends, these ETFs can work together to get you closer to financial independence, on your terms. Remember, it's not just about income, it's about building a portfolio you can trust for the next 10, 20, or 30 years. If you enjoyed this breakdown, hit that like button. And don't forget to subscribe to Wealth Hacker for more deep dives into ETFs, investing strategies, and financial freedom. Stay smart, stay invested.